Hello, everyone. Welcome back to Chapter 11, which is capital gain type of issue that we're going to cover. So if you look at Module 11, Week 11, Module 11, capital gains and losses, I put a lot of good information here for you to kind of read it, but I want to just for a moment go to that last one, advanced topics, section 1231, 1245, and section 1250. Kind of understand them. I think ahead of time, it will be better. Then we go forward. Okay, so let's go over these sections slowly. So there are some advanced topics that is not that much in your book, but I think you need to know. Those who own business property may be interested in understanding of differences between these three types of rules: section 1231 property, 1245 property, and 1250 properties, as they can be helpful in the tax planning. Okay, section 1231, 1245, and 1250 of Internal Revenue Code provides categories for different types of business assets and define how each will tax with and when at the time of disposition. So the keyword I like to emphasize is here. So those are all business assets. So section 1231, 1245, and 1250, they are business assets. Section 1231 is the umbrella, which below that umbrella, you might have a tax issue, and the tax issue, then you have to refer either identify that tax issue as 1245 property or 1250 property. Make sense? So let's go slowly with 1231 property first. So section 1231 property is in a trade or business subject to depreciation rule and held for more than a year. So anything that you hold for more than a year, obviously you need to depreciate. Let's say building, equipment, automobile, machineries. It also applies to real property used in the trade or business, held for more than a year. So any real property is included. This category does not include inventory or property held for sale. Why? Because inventory, let's say you are in a business of selling t-shirt. The t-shirt is your inventory. You never, ever depreciate that. That's not a section 1231 property. It's your inventory. If it's sold, becomes cost of goods sold. If you keep it, becomes inventory, current asset. If it is damaged, then you write it off, loss on inventory valuation, and you will recognize as cost of goods sold in general, unless it's very heavy damage. So inventory or any property that you hold to sell to your customers is not any way close to being a section 1231 property. And it does not include intangible assets such as patent, inventions, copyright, and like those type of things. Examples of section 1231 property that are depreciable business asset includes with useful life, exceeds 1 year life. So make sure you understand that it has to exceed 1 year life, has a estimated useful life of 3 years, 5 years, something like that. And it has to be a business asset. This includes machineries, equipment, building, automobile, computers. All of them are section 1231. Also includes land, timber, livestock, and unharvested crops. but it does not include poultry. Poultry is not included. And when here we say harvested crops, because the moment the crops are harvested, they become inventory. Make sense? But as long as it's not harvested, it's still part of Section 1231 property. Even livestock is Section 1231 property. When Section 1231 property is sold at a gain, the amount is in excess of property's basis, and depreciation receives capital gain treatment. So it's important to understand, if you sell it at the gain, it will receive capital gain treatment, which it means lower tax rate, right? And lower tax rate is like 0%, 15%, 20%, depends on your income. However, while the amount attributed to depreciation recaptured is treated as ordinary income. So anything that is related to recaptured depreciation, it has to consider as ordinary income and will be taxed as such. Why? The answer is easy, because when you depreciate the property, you reduce your ordinary income. And when you reduce your ordinary income, you pay less ordinary tax rate, right? Your ordinary tax will be lower because of that depreciation. Now that you sold it and you have a gain, it says, okay, how much of that amount is above the basis? That is a capital gain. However, the part that is recaptured from the depreciation, it will be recognized as ordinary income, and you pay ordinary income tax rate. Ordinary income tax rate for most people might be higher than more friendly capital gain taxes. So when Section 1231 property is sold at a loss, the loss is treated as ordinary loss, which is good, and may be deducted in full against ordinary income. So that's a good thing, because if you have a loss, they will let you treat as ordinary loss, and ordinary loss is so good. Why? Because ordinary loss, it can be directly applied to ordinary income and wash it away and pay less taxes. How about capital loss? Why capital loss is not that good? Because if you have capital loss and you don't have capital gain to write it against it, then your capital loss will be limited to $3,000 every year to use against ordinary income, right? So capital loss is not that much good, because it doesn't let you to, use it, all of it, or as much as you, but capital ordinary loss, here says treated as ordinary loss. That's really good, because you can directly apply against ordinary income, and boom, your income will be lower, and there you go, you pay less taxes. Got the difference? So this is technically more favorable than capital loss treatment, which limits capital losses to $3,000 per tax year, unless other capital gains are available to offset the losses. So far, so good? So one primary advantage is, if sold for a loss, the taxpayer gets an ordinary loss rather than long-term loss. That's beautiful. Gain, however, is preference, lower than ordinary rates. So gain, normally you have favorable rates, which is 0%, 10%, 0%, 15%, and 20%. Okay? And any of the capital gain that comes from recapture, any gain that comes from recapture of depreciation recapture, that will be treated as ordinary income, and you pay tax as ordinary income. Okay, now that we know what 1231 exchange is, property is, now 1231 property at the time of taxation might be a 1245 property or might be a 1250 property. It might be one of those. So let's see which one it might be. So 1245 was put in place to ensure the tax benefits of depreciation are considered when businesses sell certain tangible and intangible assets on which a depreciation or amortization deduction has been allowed. Example of 1245 properties include furniture, business equipment, light fixtures, carpeting, those type of things. Section 1245 property does not include building and structure component, which all fall under section 1245. So this is a very important sentence. So 1245 is not including building and structure component. That is 1250. So anything besides building normally falls into 1245. Building is 1250. Section 1245 property is not truly a separate class of property from section 1231. That means section 1231 is the umbrella and section 1245 is right below that umbrella. Literally almost a portion of that is 1245. Anything in the under umbrella of 1231 might be either 1245 or 1250. So section 1245 property is not truly a separate class than section 1231. Rather, section 1245 property may be defined as certain types of section 1231 property on which there exists an unrecaptured, allowed or allowable depreciation or amortization deduction. Unrecaptured, that means still is not depreciated. The importance of section 1241 comes into play when a business sells business property at a gain. Here is the important. When section 1241 property is sold at a gain, amounts previously claimed as a depreciation, allowed or allowable, are recaptured at ordinary tax rate. So whatever is already claimed as depreciation will be ordinary income tax rate, will be under ordinary income tax rate. However, the remaining gain is taxed at capital gain rates. Okay, the remaining will be taxed under capital gain tax rate. And capital gain tax rate are much more, favorable. This is because they have already received favorable tax treatment on the property through depreciation. That's why they have to go through ordinary income. So whatever is depreciated goes through ordinary income tax rate. Whatever is not, is just regular gain, it will be considered as capital gain loss. Just so you know, for this year, 2023, I have the following tables for you to look at. So 0% tax rate applies to people who have lower income, single up to 44,000 and married up to 89,000. But if your income as a single is more than 44,000, you get 15% tax bracket. which most people fall in that area. If you are married, anything above 89,000 will fall into 15% tax bracket. However, if your income as a single is more than 492,000, then you start paying 20% capital gain rate. And if you're married filing jointly, that will be 553,000. If Section 1245 property is sold at a loss, the property follows Section 1231 rules. And the loss, which is very good, is ordinary and offsets ordinary income. That's fantastic, provided the chance that you can write it off against ordinary income. Okay, what is 1245 property defined in nutshell? So technically, one more time, it is a new or used tangible or intangible personal property that has been or could have been subject to depreciation or amortization. Examples of tangible personal property are machineries, vehicles, equipment, grain storage bins, silos, and furnaces, bricks, kilns, that means where they cook bricks, ovens. Examples of intangible personal property are patent, copyright, and trademark. Okay, let's go to 1245 anyway. Section 1250. 1250 generally applies to real property. So if it's a real property, it's not 1245, it is 1250. Like commercial building, rental houses, real property components such as roofs, floorings, those type of things. Those are all 1250. That are depreciated over a long period of time, then Section 1245. Section 1245, normally you depreciate 3 years, 5 years, something like that, 7 years. But real estate property, you depreciate them 39 years if it is commercial real estate, 27 and a half years if it is rental real estate, residential real estate. Okay, so this is the tricky part a little bit. When Section 1250 property is sold at a gain, the difference between the straight line depreciation and accelerated method claim is taxed as ordinary income. So remember, if you decide to do accelerated depreciation and you sell it one day with a gain, anything that it is more than straight line depreciation, it will become ordinary income because looks like you tried to do accelerated depreciation to reduce your ordinary income and pay less ordinary income tax rate. That's why IRS says if you use accelerated depreciation, then that amount of accelerated depreciation, the difference between accelerated and straight line, will be calculated as ordinary income taxable. While the rest of the gain is taxed at capital gain rates. Okay, so the rest will be capital gain rates, and that is much more favorable. So the portion that you depreciated, it will be, and you have a gain, that will be treated as ordinary income. The other remaining balance will be treated as capital gain and will use more favorable rates. So Section 1250 property, the main issue is additional depreciation over straight line depreciation. That's where you get kind of penalized to pay ordinary income tax rate, whatever is the difference. So Section 1250 addresses the comes from the sale of depreciable real property. Again, Section 1250 is real property, such as commercial building, warehouse, rental properties, structural components like roofs and if you have gains on that depreciated part, anything over straight line will be taxed at ordinary tax rate because you depreciated faster than straight line. However, tangibles and intangible personal properties and land acreage do not fall under these regulations. Okay. Section 1250 is chiefly applicable when a company depreciates its real estate property under accelerated depreciation method, resulting in larger deduction in early life of real asset compared to straight line. That's why they want you to pay ordinary income tax rate. On that, the difference, anything above straight line, the difference higher than straight line, that's ordinary tax rate. Section 1250 states that if a real property sells for a purchase price that purchases a depreciation and straight line depreciation, that purchases tax gains. Let me do it again. Section 1250 states that if a real property sells for a purchase price that produces a taxable gain, the owner depreciates the property using accelerated depreciation method. The IRS taxes the difference between actual depreciation and straight line depreciation as ordinary income, which we just covered. In sum, sections 1231, 1245, and 1250 provide classification guidelines for different type of depreciable business properties and how they are subject to taxation. So let's look at an example here, you will see. If a property was initially purchased for $150,000, so far so good, the owner claims depreciation of $30,000, assuming straight line, okay? I think, assuming straight line, not accelerated. For the property is considered to be $120,000. So the property adjusted basis is 120, 150 minus 30 depreciation, accumulated depreciation. Net book value is 120. That's adjusted basis. If the property is subsequently sold for 185, okay? So 185 minus 120 adjusted basis, that gives you $65,000 gain. So far, so good? Since the property has sold for more than the basis, that has been adjusted for depreciation. The unrecaptured Section 1250 gains are based on the difference between the adjusted cost basis and the original purchase price. So this makes the first $30,000 of profit subject to unrecaptured section. So $30,000 profit is unrecaptured section. And that's to Section 1250 gain. While the remaining 35,000, which is the 185 minus 150, is taxed at the regular long-term capital gain. So that $30,000 is subject to ordinary income, but the $30,000 would be subject to capital gain tax, which is much more favorable. The remaining $35,000 would be taxed at the long-term capital gain rate of either 0, 15, or 20, depending on the taxpayer's income. Okay, now watch this one. Let's go here so we can kind of look at it. We have 1231 exchange sales of or exchange of 1231 asset. You might have a loss, you might have a gain. Let's go with loss, which is easier. If you have a loss, the tax benefit is good because it will be treated as ordinary loss. And that's very good because you can use it against any income, ordinary income. You can use it against ordinary income easily. But if it was capital loss, it would be only applicable to capital gain. And anything that it was not used will be carried forward. And every year you can only deduct up to $30,000 of that capital loss, not more than that, towards your ordinary income. Make sense? So it's ordinary loss is very good. So that's the good thing. Keep it that. Let's go back. Let's go to gain. Let's say we have a gain. If it is like a personal property, or it might be real property. If it's personal property, then it's 1245 asset. Section 1245 type of asset is anything besides real property, like automobile, like machineries, equipment, anything that doesn't have, long depreciation, like real estate property. So to extent of the depreciation, gain is ordinary income. So if you have a gain on personal property, as much as you have a depreciation recognized on that, that portion will be ordinary income. We call it depreciation recapture. That means you recapture the depreciation and you recognize it as ordinary income and you pay tax for ordinary income, which might be high in most cases. Of course, everyone's ordinary income tax rate is different, but it can be as high as 37%. But let's go back here and talk about real estate property. So if it's a real estate property, we call it 1250 asset. Real estate property doesn't have 5 years life, 7 years life. It is 27.5 years for residential and 39 years for commercial real estate property. Okay, so you have a gain on that. Now what? If you have a gain on real estate property, few things might happen. First, additional depreciation. Additional depreciation happens when you use accelerated depreciation. And then you say, okay, my accelerated depreciation compared to straight line depreciation was this much. That amount will be ordinary income, which is the highest possible tax rate. Assuming you never did accelerated depreciation for the real estate property and you used only straight line depreciation. So to extent of straight line depreciation, gain is unrecaptured 25%. So to extent of straight line, the gain is unrecaptured and is 25%. Anything left over, because you have a gain, right? That gain comes from depreciation. If it comes from depreciation, these two things might happen. If that gain is not, it's above and separate than depreciation comes additional depreciation, additional gain, we call it capital gain, and that capital gain will end up to be based on that 0 or 5 or 15, the 35 gain is capital gain based on this, based on that area. Okay? Now imagine you have a gain, capital gain in here, and you might have a loss if you have a loss. So bottom line, you have to net them. Let's say you have two different scenarios. You net them, and then loss, remainder is 1231 loss, which is ordinary loss. And then if you have a gain, that will be capital gain that you will get tax on capital gain. So that should be right here. And that will be calculated in your software again. All you need to tell the software that what type of property is it, business, building, real estate, machineries, equipment, and then purchase price, the date of purchase, all those stuff, and how much has been depreciated. If you are using the same software over and over, that will be great because already your software knows how much has been the depreciation up to that moment that you sold it, and your software will easily calculate what portion of that gain will be ordinary, based on ordinary income tax rate, what would be based on capital gain tax rate, and also the software will look at your income level and will decide which of these tax rate will apply to your situation. So in general, we have Section 1231 type of property. That property is an umbrella. It covers either personal property, which is 1245, they call it, including automobile, equipment, machinery, something like that, or it's a real estate property, which is 1250. Okay, hopefully that makes sense. It is obviously a little bit hard to capture all of that, but it is funny. So in chapter 11, we are looking at capital gains and losses, and again, depreciation recapture, which we just covered a lot of things about it. So let's go forward and see what we can do again. These are the learning objectives in your book. And let's go to capital asset. So what is capital asset? All properties that taxpayers own is a capital asset, okay? Unless it falls into one of the following 5 categories. So everything you own is a capital asset unless it is one of these 5. What are those 5? Number 1, inventory. So the inventory, including work in process, raw materials inventory, finished goods inventory, those are all inventory. So it's not capital asset. Business receivables, like accounts receivable, notes receivable, that's not capital asset. Depreciable property and land used in a trade or business, that's not capital asset either. So it looks like capital asset does not like business type of things. You see, these number 1, 2, 3 are all business stuff. Copyright and musical and those type of patent, inventions, models, designs, those are all not capital asset. However, here says composers of musical compositions and creators of copyrights may elect to treat their work as capital asset, but that's a separate thing. U.S. government publications purchased for less than the normal sales price, that's not also capital asset. So a closer look at 5 categories reveals that first 3 involves business properties. Therefore, thus, except for items described in the last 2 categories, capital asset can be defined as taxpayers' here personal belongings and investment property. So that's what we call it, capital asset. Common examples of capital asset includes the taxpayer's clothing, residence, automobiles for personal use, stock, bonds, portfolios, land held for speculations as an investment property. Those are all capital assets. Those are personal things. Using the rule from Chapter 10, taxpayers compute the realized gain and losses that results from sale of exchange of capital asset, and they pay capital gain tax if it's necessary. Next, they determine which realized gain and losses they recognize for tax purposes. Because not every gain is taxable, but again, first you need to understand if it's realized or not. And after you know it's realized, then you decide to recognize it as a taxable gain or not. So short-term capital gains and losses results from sale of exchange of capital assets held for 1 year or less. If you hold it for more than 1 year, then it ends up to be long-term capital gain. Long-term capital gain has lower and more favorable taxes. Okay? Okay, so on June 3rd of 2021, Thomas buys 100 shares of common stock. Thomas holding period begins on June 4th of 2021. On June 4th of 2022, Thomas will have held the shares for more than 1 year. If Thomas sells the share after June 3rd of 2022, he will recognize a long-term capital gain or loss. This of course assumes that neither to wash sales rule nor the related party rule from Chapter 10 prevents Thomas from recognizing a loss on the sale. So remember the wash sell rule. You cannot buy or sell, 30. You cannot, buy or sell 30 days before and 30 days after. That's a 60-day rule, okay? Inherited property, just as a reminder, if you get inherited property, doesn't matter how long you keep it. You can keep it for a month. You can keep it for 2 months. It will be a long-term anyway. So the holding period for property inherited from a descendant is considered to be long-term no matter what. So in this example, Mariah inherited stock from her aunt. Mariah's basis in the stock is its $10,000 fair market value on DOD. Remember DOD, date of death, on March 3rd of 2023. Okay, so fair market value is the basis on that date. Mariah sold the stock for $12,400 few months later in November of the same year. Although Mariah's ownership of the property did not exceed 1 year, she recognizes $2,400 long-term capital gain on the sale of inherited stock. Got it? So inherited stock is going to be capital gain no matter what. How about carryover basis property? When property has a carryover basis, the holding period also carries over. A carryover basis and holding period can occur one of 3 ways. The taxpayers use the previous owner's basis to compute the basis in the property. This occurs when transfers of property between spouse, gifted property, where the taxpayer used the donor's basis, and the property inherited from decedent dying in 2010, where the carryover basis rules were used. Only in 2010. Otherwise, gifted property is what? I mean, inherited property. Otherwise, inherited property is always long-term, right? But just in 2010 was different. In 2010 was same as gifted property. In these cases, the previous owner's holding period carries over to the taxpayer. Scenario 2, the taxpayer allocates part of the basis in existing property to the basis of newly acquired property. This happens with non-taxable stock dividend and stock split. Remember, when stock dividend and stock split happens, you have all of a sudden a lot of stock, right? Guess what? The holding period is carrying over from the old stock that you bought a while ago. So don't think, oh, because you got it brand new stock, then its holding period is short. Number 3, the taxpayers adjust the basis in property to reflect a postponed gain or loss from previously owned property. This can occur when like-kind exchange, 1031 exchange, is involved. Involuntary conversions and buy sales. In these cases, the holding period of the old property carries over to the new property. So let's look at maybe that one. On March 10 of 2022, DOT exchanged land for a building in like-kind exchange. DOT's holding period for land dates back to August 18 of 2013. DOT's holding period in the building acquired in the like-kind exchange begins in August 18 of 2013. So the holding period for the new property will be same as the old property. Make sense? That's a tricky, important part. Okay, let's talk about netting these capital gains and losses, which is, again, will be done by your software, but we are just trying to understand it for quiz purposes. Okay. So let's look at this scenario. Mandy sold the following capital assets during the year. Mandy had stock held 6 months, and because it's 6 months, the gain is a short term. The stock that held 8 months, we got a loss, but that loss is also short term. But we have few stock that held 3 years, and we have a loss. That's a long-term loss. And again, held for 6 years, that's more than a year. That's a capital gain, long-term. Now let's do the netting. The first step in netting process involves separating the gain and losses into 2 groups. See the columns in here. So short term, we take the $5,000 gain less $7,000 short-term loss. So we have 2,000 net short-term loss. On the other side, we have 14,000 net loss plus 21, long-term loss plus 21,000 long-term gain. That gives us a net amount of 7,000 long-term gain. The netting process produces 2,000 short-term and 7,000 long-term. Now, when a net gain results in both groups, the netting process is finished, complete. If it's net gain here and net gain over there, that means you have to stop. Likewise, if you have netting process is complete, then both groups row is net loss. So if net loss on the left and net loss on the right, then you stop again. Otherwise, like this scenario, netting loss against gains between the two groups will happen. You have to continue. You cannot stop it. Like this scenario, you cannot stop it. You have to go. So here we go. Now we offset. You see that $2,000 short-term loss? We take that loss because gain is bigger, right? So that smaller number goes below the bigger number. So 7,000 positive number minus 2,000 short-term loss gives us $5,000 capital gain. So this leaves Mandy with 5,000 overall net long-term capital gain. Make sense? And you carry over this, it's a long-term capital gain, you just pay the favorable taxes. If it is a short-term capital gain, then you write it down in future against capital gains you might have, or if it is short-term capital loss, you can deduct it up to $3,000 a year against ordinary income in future. So every year you can deduct how much? 3,000 short-term loss. Every year 3,000. So Brooks sold 4 capital assets during the year. After separating the gains and losses into 2 groups, Brooks nets the gain and losses within each group. This netting within the group produces 2,000 net short-term loss and 3,000 net long-term loss. Since both groups result in loss, the netting process is complete. And you keep this and you carry forward to use it in future. So let's keep going, maybe another example. Yes. So here is A sold 5 capital assets during the year. 1, 2, 3, 4, 5. So short term is $13,000 loss, $7,000 gain, and $11,000 gain. Let me see where that 11,000 is coming. The netting within groups result in 5,000 net short-term capital gain and $1,000 net long-term capital loss. Yeah, so this 11,000 came from somewhere. So we have 2 capital gains in here, but one of them is short-term loss. So 13 plus 7 plus 11. That gives us 5,000 short-term loss. Short-term gain, 5,000 short-term gain. On the other side, we have 3,000 gain, 4,000 loss, long-term. So we net that. That gives us 1,000 long-term loss. Now that we are down to this point, none of them are same. One of them is gain, one of them is loss. Then you are not complete. You have to continue. So you take this $1,000 to the other side, take it from short-term gain, and all of a sudden your short-term gain ends up to be $4,000. Once the netting process is complete, individual taxpayers with a net capital gain pay a reduced tax rate on the net capital gain. Net capital gain equals the excess of net long-term capital gain over the net short-term capital loss. If the netting process produces a net long-term capital loss or overall capital loss, then the taxpayers have zero net capital gain. If the netting process produces both a net capital long-term and capital gain, net long-term capital gain and net short-term capital gain, then net capital gain equals the net long-term capital gain. So let me translate this a little bit easier. This was here. If the netting process produces both a long-term gain and net short-term capital gain. So we have two types of gains. Both of them are long-term gain and short-term gain. Then net capital gain equals the net long-term capital gain. That means we have at the end a net capital gain, but long-term. We're going to get to an example that makes it easier. Taxpayers with net capital gain or qualified dividend compute their tax liability by subtracting out this amount from taxable income and computing tax on the remaining amount. So net capital gain, remember, you have favorable tax rate. So you don't want to mix it up that with your ordinary income. You want to separate them. Same thing on qualified dividend. You want to separate them also because they have favorable tax rate. That's why it says compute those and then separate them from taxable income so you can get the benefit out of that favorable tax rate. They then add to this amount the tax on the net capital gain and qualified dividend. So you calculate two types of taxes. One tax is tax from your ordinary income, whatever it might be. Then you add to that tax the tax from your capital gain, which is much more favorable. And then add them up. That will be your total tax due. The tax rate on net capital gain and qualified dividend is 0% for taxpayers whose taxable income is less than $83,000 for married filing jointly, less than $55,000 if head of household, and less than $41,000 if single or married filing separately. The rate increases to 15% if you have higher income, and the maximum again is 20% if your income is more than $500-something thousand. And that is every year changing, so I don't suggest to memorize this, but every year is different, so you, as long as you know 0, 15, and 20, that's enough. Okay, here is an example. Abby's taxable income for 2022 is $135,000. Abby's filing status is single. Included in the taxable income is $15,000 of net capital gain. So if you have net capital gain, that will be good, favorable tax rate. Abby's 2022 tax liability is computed as follows. Tax on 120, which is 135 minus 15. Using tax table, regular taxable income, and you calculate a dollar amount, let's say $22,000. Then, based on Abby's income, we realize that that 135,000 falls into 15% tax bracket for capital gain. So 15% favorable tax rate times $15,000. That will be another $2,250, ends up to be $24,886 total tax liability. So we calculated twice, not once. Once for ordinary income, one for net capital gain. Same fact in example 10, except that Abby's taxable income is 500. Okay, so single people with such an income, they get to maximum capital gain tax rate of 20. So tax on $485,000 will be $143,503, and the remaining 15,000 will be much more favorable, which is just 20%. So instead of paying 37% here, we pay just 20% the maximum capital gain tax, which is ending up $3,000, and then we add them up. Now here it's the same fact as example 10, except that Abby's taxable income is $50,000. So Abby is low income. However, when you take out the qualified dividend, $0, and net capital gain of $15,000, taxable income drops to 35. The ceiling for 15% tax rate is $41,675. Therefore, only $6,775 of her net capital gain is taxed at the lowest zero tax rate. The rest is taxed at 15%. So tax on $35,000 using tax table for single taxpayer is $3,998, which is about, I believe, let's say 10%, 12%, something like that. Then the remaining, whatever is above the difference of the threshold. So 35, 41, 675 minus 35,000, that is ordinary income. So that's the threshold. So 6,775 is multiplied with the tax rate of 0% because she's low income. And 15,000 minus 6,775, that is above that threshold of 41,000, that falls into 15% tax bracket. Make sense? So a portion of the capital gain will be taxed at 0, and the portion of the capital gain will be taxed at 15%. Anything between income and the threshold is 0%. You remember that threshold, right? You see that? The threshold is 0%. So if you have any income between 0 to 44,000 is 0%. But if your income goes above that, then it's different. Then it's 15%. So then you can add them up and to figure out what's the tax liability. Okay, I think it's good enough up to here. We are already tired. It's a lot of talking. We continue next time from net capital loss. I definitely suggest to review whatever we just did again, just to kind of absorb it a little bit, and we go from that point forward. For CTEC, one more time, if you like to get a CTEC, you need to get 60 hours education credit. 60 hours education credit you will receive if you pass the 4-part exam that I have in Canvas at Pasadena City College with 70% or better results. of course, you have to pass the course and get 70% or better in your CTEC exam. Make sense? Assuming all that happens, then you can get that 60 hours education credit reported by me to CTEC. In order to report that, I need you to get a CTEC ID and give it to me, your CTEC ID, so I can tell CTEC who has that 60 hours education. Before, a few years ago, was Social Security number, but now they changed it to CTEC ID, which is much better. So now, in order to get that CTEC ID, you have to become a member of CTEC, right? In order to become a member of a CTEC, you need PTIN number, which needs, you need to go to irs.gov to get a PTIN number. That's another $30, $40 fee. And you have to renew it annually. No matter you are CPA or CTEC, you have to renew that PTIN. So get a PTIN from IRS, give it to CTEC so you can get a CTEC ID. On top of that, I think you need to have a bond, and you have to have also fingerprinting. Now, so they do background check, fingerprinting, all those stuff. But the first thing first I need is your CTEC ID so I can give it to ctec.org. And then let's say 2 weeks later, when you are trying to get your CTEC permit, the education is already sitting there, okay? I will enter that CTEC information as soon as the course finishes and I have all the information from your side, and that will be moment that I will enter it to CTEC. Right there, you have all the information to continue to get your CTEC permit. If you like to skip that CTEC permit and get the enrolled agent license, then please go ahead and study the first part exam that I gave you for free. Register with irs.gov to sit for enrolled agent license examination in Prometric offices. There is a Prometric office in most cities available, so you can find a Prometric office near you, make an appointment, pay the fees, whatever it is, and because you are already registered with IRS, so your Prometric will let you to sit for IRS exam. You pass part 1, and then that's individual, and then you take business, that's part 2, and the last part is representation, that's part 3. So part 2 and 3, you can buy it from glime.com for your study package, but part 1, I already gave it to you, so that's easy. And enrolled agent license, it's a license, like a CPA license, and you can represent anyone at any place in the United States.